Did you know that the average U.S. small business owner overpays their taxes by nearly $11,000 every single year? That is money that could have gone into your marketing, your retirement, or your family's vacation fund. If you were running an LLC or working as a freelancer, you were likely part of this statistic, not because you're doing something wrong, but because you're playing the game by the old rules. In this video, we are breaking down the high-level tax-saving strategies that the IRS doesn't advertise but legally allows to ensure you keep every possible cent in your pocket. This is the difference between surviving tax season and mastering it. If you want to stop being a donor to the government and start being a savvy CEO, pay very close attention to what comes next. Let's start with the biggest misconception in the world of entrepreneurship, the idea that simply having an LLC saves you money on taxes. Here is the cold, hard truth. A standard single-member LLC is treated as a disregarded entity by the IRS. This means you are taxed exactly like a sole proprietor, paying a staggering 15.3% in self-employment tax on every single dollar of profit you make. But there is a massive legal glitch used by high-earning freelancers and small business owners called the S-Corp Election. By electing to be taxed as an S-corporation, you can split your income into two parts, a reasonable salary and a business distribution. You only pay that 15.3% self-employment tax on your salary, while the rest of your profit is exempt from it. For someone making $100,000 a year, this single move could save you upwards of $5,000 to $8,000 annually. But building a tax-efficient empire isn't just about your business structure, it's about how you categorize your life. To truly maximize your financial health, you need to look at your expenses through a professional lens. Most freelancers think a write-off is just a small discount. In reality, a write-off is a strategic tool to lower your taxable income bracket. Think about your home office. It isn't just a desk in a corner. It is a calculated percentage of your rent, your mortgage interest, your utilities, your high-speed internet, and even your home insurance. If you are not calculating the exact square footage of your dedicated workspace versus your total home size, you are literally leaving thousands of dollars on the table for the IRS to claim. And then there's the power of Section 179. If you invested in new equipment this year, whether it's a high-end laptop, a server, or even certain heavy vehicles used for business, you don't have to wait 5 or 7 years to slowly deduct that cost through depreciation. Under Section 179, the IRS allows many business owners to deduct the entire purchase price of qualifying equipment in the very first year you put it into service. This can effectively wipe out a massive chunk of your tax liability in one fell swoop, allowing you to reinvest that cash back into your growth immediately. This is how the wealthy stay wealthy. They don't necessarily spend less, they spend smarter by making the tax code work for them rather than against them. This is just the foundation of a bulletproof tax strategy. Moving beyond the basic deductions, we enter the realm of wealth preservation, where you don't just save on taxes, but you use those savings to build a massive retirement nest egg. The single most effective tool for a high-earning LLC owner is the solo 401k. Unlike a standard employer-sponsored 401k, a solo 401k allows you to contribute as both the employer and the employee. This means you can effectively shield up to $69,000 of your income from taxes every single year, depending on your earnings. If you're in a 35% tax bracket, maximizing this one account could reduce your tax bill by over $20,000 instantly. Compare that to a traditional IRA where your limit is just a few thousand, and you can see why the solo 401k is the gold standard for freelancers who want to get rich while the IRS watches from the sidelines. But the strategies don't stop at retirement accounts. Let's talk about a secret weapon often called the Augusta Rule, or Section 280A of the tax code. This rule allows you to rent out your personal residence to your business for up to 14 days a year without having to report that rental income on your personal tax return. Imagine hosting your monthly board meetings or strategic planning sessions at your home. Your business pays you a fair market rental rate, let's say $1,000 a day, and deducts that $14,000 as a legitimate business expense.
you receive that $14,000 completely tax-free. It's a perfectly legal way to shift money from your taxable business bucket into your tax-free personal bucket, provided you document the meetings and the market rates correctly. Then there is the Health Savings Account, or HSA, which is quite literally the only triple tax-advantaged account in existence. If you have a high-deductible health plan, you can put money into an HSA tax-deferred, let it grow through investments tax-free, and withdraw it for medical expenses, which everyone eventually has, completely tax-free. For a freelancer, this isn't just a health account, it's a secondary retirement fund that the government can't touch. Most people miss this because they treat it like a use-it-or-lose-it flexible spending account. But a savvy LLC owner knows that an HSA is a long-term wealth vehicle. To manage all of this without losing your mind, you need to move away from messy spreadsheets and into high-level automation. Software like QuickBooks Online or FreshBooks isn't just for sending invoices, it's for real-time tax estimation. When your software is synced with your business bank accounts, it uses AI to categorize your spending and flag potential deductions you might have missed, like that recurring software subscription or the professional development course you took last month. By the time April rolls around, you shouldn't be doing your taxes. You should simply be reviewing the masterpiece of financial engineering you've built throughout the year. As we scale our tax-saving strategies, we have to talk about the one thing that keeps every entrepreneur up at night: the dreaded IRS audit. You can have the most sophisticated tax structure in the world, but if your documentation is a mess, the IRS will dismantle it in minutes. To audit-proof your life, you must follow the rule of conterreptitious documentation. This means you don't wait until the end of the year to find receipts. You use digital tools to capture them the moment the transaction happens. Every dinner meeting must have a note on the receipt stating who was there and what business was discussed. If you're using the Augusta Rule we mentioned earlier, you need actual meeting minutes and a printed calendar showing that the board meeting took place. The IRS doesn't just look for what you spent, they look for the intent behind it. Keeping your personal and business bank accounts strictly separated is the first line of defense. If you are piercing the corporate veil by buying groceries with your business card, you are handing the IRS a golden ticket to audit your entire life. For those of you looking to take your business global or working as a digital nomad, the complexities increase, but so do the rewards. If you're earning income internationally, you need to be aware of the foreign earned income exclusion, which could allow you to exclude over $120,000 of your foreign earnings from U.S. federal income tax if you meet the residency requirements. However, don't forget about Nexus. Even if your LLC is registered in a tax-friendly state like Wyoming or Delaware, if you are physically working from a high-tax state like California or New York, those states will want their cut. Understanding state-level tax nexus is the difference between keeping your profits and losing them to a state treasury you didn't even know you owed money to. As we wrap up this masterclass, remember that tax planning is not a one-time event in April. It is a 365-day strategy. The most successful entrepreneurs I know meet with their CPA at least once a quarter to adjust their estimated payments and pivot their strategies based on new laws. Don't fear the tax code, master it. It is the largest expense you will ever have in your life, and reducing it is the fastest way to increase your net worth without having to make a single extra sale. If you found this deep dive into LLC tax strategies valuable and you want to stop overpaying the government, make sure to hit that like button and subscribe to the channel. We post high-level financial breakdowns every week to help you keep more of what you earn. If you have a specific question about your LLC or a deduction you're unsure about, drop a comment below. We read every single one. Thank you for watching, and I'll see you in the next video where we discuss how to invest these tax savings into high-yield assets.